Well, hello everybody. It's Paul here. We're Monday, 22nd of October. I appreciate that we have here in the UK that we have a sort of half-term school holidays this week and next week. Okay, so I appreciate that some people will be watching this on demand later if they're busy looking after their children this week. But here we are. We're here for I think what is it, probably our 13th or 14th session of the Mastering the 4 M's of Trading webinar, a series from Admiral Markets here about helping you understand and develop your own knowledge and competence within those 4 M's of trading. As always, I look to begin with a very quick risk disclaimer. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 83% of retail investor accounts lose money when trading CFDs with Admiral Markets. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please ensure you fully understand all risks involved. Forex and CFD trading is a risky activity, and this presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the author. This presentation and accompanying video is for information and educational purposes only. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with the maximum payout of £50,000 sterling as per our negative balance protection policy. Admiral Markets provide a wide range of products and services for their clients. Their particular very attractive products, namely being DAX 30 and Euro Dollar, which typically have a spread of about 0.8 points during the main trading hours. They also offer the Admiral Markets Supreme Edition version of the very popular MetaTrader MT4 and MT5 platforms. As always, if you have any questions about either Admiral Markets or this webinar or this products and services they offer, then please feel free to get in touch with the account representative and they will be happy to help and guide you. So here we go, ladies and gentlemen. Those of you joining us for the very first time, what I normally have in these Mastering the 4 M's trading webinars is just the first few slides is effectively is a little bit of a week by week, building by building, based upon all the sessions we've covered so far, and the idea being that the more it gets repeated to you, the more it kind of sinks in and becomes your standard approach to sort of trading. For those of you who don't know me, okay, primarily I consider myself to be a discretionary based method trader. I'm very big on keeping it simple, and I like to merge fundamentals, technical, sentiment, geopolitics into my trading decisions. Primarily for myself, I am an FX indices and commodities trader who's looking to buy strength and sell weakness using pullbacks for entries. For the intraday trading that I do, which we'll cover much later on in the series, is that I'm primarily a mean reversion trader. If you're very new to trading and don't understand that particular term, have no fear. As you join us week on week, you'll learn all about these particular terms and begin to understand what they are and how you can utilize them in your own trading. As always, every week I like to set the expectations that for me, my expectations to help educate you about the 4 M's of trading so that you're in a position to go away and begin to analyze any market and be ready to trade it regardless of what your own particular trading favorites are. And also, as we go into this sort of moving into the sort of the money management and managing myself, we're talking about how we can help raise your self-awareness about managing risk and about managing yourself. What I also ask is just that I appreciate we have a broad range of experience in the room, and that I have a time limitation of 45 minutes. So that means that I can't always go into the breadth and depth of topics that I would like, but I'm always going to try and focus on something that you can use tomorrow. That's what I think is probably the most help for you as a trader. So there'll always be something in every session that you can take away and start to look at, in your own trading from tomorrow. And I hope that, as I say, helps sort of you develop and grow and evolve as a trader, because that's what I'm here to do. So, I appreciate most of the people who join us have seen either joined us for previous sessions or have watched these sessions on demand. And in session one, okay, which is on the Admiral Markets YouTube channel, it's also on the Admiral Markets Facebook page. And what I talked about is realistically is that in all my years of trading and of actually working on trading floors and of mentoring and coaching traders from beginning retail traders up to sort of professional traders at tier one institutions, what I found was that those traders who did well consistently had an ability to understand and master the 4 M's of trading: markets, method, money, and myself. They had an ability to understand that, an ability to manage those 4 areas, and in fact an ability to master those 4 areas. And if you go back and go through session 1 again, as I said, it's on the YouTube channel, you'll be able to talk about how I go through those particular areas in a little bit more depth. For the last few months, we've been focusing mostly on markets and method, and as we progress through those 4 M's, we're going to focus a lot more on money and managing myself. But the reality is that I find is when a trader, okay, is managing those 4 M's very well, that's when they tend to be in a sweet spot and they're able to sort of to trade well. And that's what we're always looking to do, to make sure that we can trade as well as we can, based upon our skill levels and abilities. So, part of that, okay, as I've talked about, is, what helps is, having process, discipline, and self-awareness. That's what we look to see repeatedly shows up in good traders time and time again. Process, discipline, and self-awareness. And part of that is about having little routines, having little trading habits, behaviors, having trading processes that you can follow just, day in, day out, that make it a lot more easier for you to be sort of consistent and disciplined in your approach to markets. So when we talked about, right back a couple of months back now about, markets and method, we talked about having some 5 simple steps, all right? Whenever you open a chart, whatever it is, whether you're an intraday, you're a dollar trader, whether you're a weekly trader on hard commodities, or you're a daily trader of currencies, okay? It's a case of, this is what I like to see people doing because it just gets them into a routine. Step 1, define your levels of support resistance. Step 2, define if there is a trend. 3, wait to see how price reacts at key support and resistance levels. Look for price action signals at those support and resistance levels, which is what we've covered for about the last 6 to 7 weeks. And then step 5, be understanding, are they part of a bigger chart pattern? And that's actually what we're going to focus on today. We're going to have a little look at that today, ladies and gentlemen. So, what I said, step 1, all right, define your levels of support resistance. Just open your chart, start at the monthly, then the weekly, then the daily charts, and just draw in those levels of support and resistance. You can also draw in important psychological round numbers, okay? What we want to be doing is, I don't want to be, buying into resistance or selling into support. I want to know where they are. And in fact, actually, once I know where those levels and areas are, I'm actually looking to see how price reacts at those particular areas. What we next want to do is to define, is there a trend? Now, what I said is that for these sessions, we're going to position ourselves as a sort of a swing trader, okay? So we're going to be looking at sort of 4-hour, daily, weekly charts. That's where we're going to be, our focus would be. But, what we're talking about and the sort of concepts I'm sharing with you, they are what I like to consider to be sort of time frame and instrument agnostic, okay? So I don't care if you are trading silver on the weekly chart or whether you're trading Eurodollar on the 5-minute chart or you're trading DAX on the 4-hour chart, okay? What I'm going to share with you is instrument and time frame agnostic. That's what we look at. And we want to just be able to see is, can I define a trend, all right? Can you as a trader show to me, all right, that you're in a position to be able to identify whether an instrument is trending or consolidating? Because, if we need to know what the market environment is so that we can employ the correct method. So, I always say, just, we want to know, be able to tell, is that market consolidating or range bound, or is that market trending, all right? And I say it every week, okay? Good trends leap off the chart at you. Don't force it. If you find yourself forcing it, I assure you the trend probably isn't there. We also talked about, moving averages. You see on my charts, the 20 period moving average, which is the blue, the red was the 50, the green is the 200 period moving average. Lots of people go into sort of trying to curve fit them to find the very, very best for each particular instrument and time frame. That's all well and good, but I personally, I'm just using them as a very, very simple idea of dynamic support and resistance, a little bit of idea of trend, okay, a little bit of an idea of the sort of the strength of the trend, or even when perhaps that trend is coming towards the end, when it gets a little bit overextended, and that's what I'm looking for. And for those of you who join me on Tuesday mornings at 10 o'clock London time for the real-time daily trading ideas, this is what I do. I just talk about how I identify ideas, identify particular instruments that are of interest to me, just using the sort of the same concepts and ideas that I've been sort of teaching you here in the Mastering the 4Ms webinar series. So that's what we said is, we want to look then see how does price react at those key support and resistance levels, because actually what I'm looking for a confluence of events. What does that mean? I'm looking for like 2 to 4 things to come together at a particular time and place, and that is where I'm looking to do my business, okay? That's where I'm starting to get interested to place my trades, okay? And this is where some of the price action setups that we've covered for the last sort of 6-7 weeks start to come into play. I put this chart up every week because I want you to just print it off and stick it on your wall. All right, keep it simple for you new traders. When markets are bullish, be a buyer. When markets are bearish, be a seller. Define the trend and trade with it. No trend, no trade. No signal, no trade. All right. Now, very often, traders try and overcomplicate it, and I hold my hand up. I'm as guilty of that as anybody else. Okay, I'm as guilty of that as anybody else. And actually, what we want to be able to do is just to keep it simple. Okay, I said that right at the very start. I believe simplicity is key. Okay, the sooner we overcomplicate things, the sooner we start to get ourselves into a spot of bother. So that's what we want to do. Keep it nice and simple to begin with. So, there we go. 1. Define level support resistance. 2, define your trend. 3, wait, see how price reacts at those levels. At those particular areas, zones, levels, start to see, what price action signals we get at those particular levels. And that's what we sort of have covered primarily for about maybe, I think it's about the last 6 weeks or so, okay? Just sort of method in terms of, actual sort of setups and signals that you could use. I talked about right at the start of it, okay, that it pretty much boils down to one of 2 styles. You're either trading a break of a line of support resistance, or you're trading a bounce off a line of support or resistance, and it's as simple as that. I know, as I said, we overcomplicate it. We can get very caught up in that, but strip it back to its basics. Okay, just keep a simple understanding. Okay, keep it as simple as you possibly can for yourself, because the reason being is that the simpler it is, the easier it will be for you to execute consistently, and actually that's where the sort of the long-term success comes from. It comes from just being able to execute a simple plan flawlessly time and time again, rather than sort of overcomplicating your trading method. So we talked about, these are all very standard, okay, good setups, okay, that you can utilize. So first one we talked about a pin bar. Sometimes you'll hear it called a rejection candle, or a high test or a low test bar. Just remember what we said. They're very popular, okay. They stand out very, very clearly. They should. The good ones, you're looking for one that has a candle wick 2 to 3 times the length of the body. Should have a long nose protruding from all the other bars, and and the very good ones will stick out and are very obvious. And there's lots of them on the charts, okay. But it's about, remember what I said, it's just about, we're looking for a confluence of events, okay? We're looking for those pin bars to occur at certain times and places. That's when we start to get interested in them. Remember what I said is pin bars, they're likely indicators of where the biggest predators are lurking, because they show rejection of a particular area or a direction. I don't want to fight them as a private trader because it's pretty pointless. What I want to do is use them to give me an idea of the likely short-term direction. And if that's a case of me giving me an opportunity to rejoin a trend on a pullback, well then I'm a happy trader. Then we looked at engulfing candles, or some kind of, sometimes they call the outside bar. All right, they happen much more rarely than pin bars. All right, but they tend to be high probability once again when they happen at the right time and place, because it demonstrates total overwhelm. We want to see them at the end of trends because they're a reversal pattern. So we look for a big bullish engulfing candle at the end of a downtrend, or we look for a bearish engulfing candle at the end of an uptrend. And I'm looking to trade in the direction of the close of the engulfing bar. Then one of the other weeks we talked about the 3-bar reversal, which was just to give you a very simple mechanical trading system, okay, a trading tactic that you could take away and use the next day. Usual as we go. define if there's that trend, okay, in an instrument, wait for a pullback to the support resistance level, which is what we're looking to do anyway. And then for a long trade, we need 2 seller bars followed by a buyer bar, okay? So 2 red bars followed by a green bar if you want to make it as simple as possible. For a short, okay, if we're in a downtrend and we pull back, well, then I need 2 buyer bars followed by a seller bar, 2 green bars followed by, you know, a red bearish bar. Ideally, if the third candle is, if in a long, for a long setup, if the green buy bar is it's a pin bar, it's an engulfing candle, maybe an inside bar or a spinning top, that just gives us more confidence, okay? But you know, it's really about just having a very, very simple mechanical system that, you know, allows a trader to sort of, you know, execute flawlessly. That's what I need to see. That's what I'm looking for from traders. Then we looked at, one of the weeks we looked at inside bars, all right? It's the opposite of an outside bar, okay? You know, an inside bar, the high and low of the bar is fully within the range of the preceding bar. You have to think of it like an organism breathing. So it's a case of, you know, I say this every week, it's about thinking about the markets like humans. They surge, then they rest, then they surge. The inside bar should be the end of the rest, okay? And what we're looking to do is to position ourselves to catch the next surge. That's what we're actually looking for. And there's some examples of it, okay? Inside bar for me, okay, when I'm looking inside bar and outside bar, I am actually including the entire candle. I'm including the entire wicks. That's what I'm looking for, okay? So in an inside bar, I need the body and the wicks to be inside the range of the preceding bar. So primarily, not surprisingly, okay, I like to trade them as pullbacks in trends, you know, and particularly on longer term charts, things like weekly and daily setups, you might be able to see and utilize them on 4 hours to execute and manage. And you know what I talked about was, you know, when the kind of, let's say for a short trade, when the low of the bar is very close to the edge of the range of the mother bar, I'd be looking for wait to that break, and you know, and that's just using a little bit of common sense based upon what you trading, what you see in front of you. But as always, you know, you have to be beware of false breakouts. They can also be used in true breakouts. You wait for a breakout to occur, then you wait for an inside bar to be printed, and then you're looking to trade in the direction of that particular breakout. Okay, and that can be a very useful, very simple way to trade breakouts for some traders. Okay, as I said, you know, I personally prefer pullbacks, but I also, I will trade breakouts when I get a nice setup, and you know, and I appreciate some people prefer to trade breakouts, and that's okay. That's absolutely okay. You know, as we're going to go on to later on down in the series, it's about working out, you know, which is your particular trading style, and being able to sort of meld your method around that, because that is, as I said, it's about being able to be simple way for you to sort of consistently trade day after day, session after session, week after week, month after month. Then we looked at key day reversals and momentum reversal candles. All right, so key day reversal is a bit of a sharp reversal pattern that occurs normally at the end of a trend. So in an uptrend, price can basically, will open either above for maybe stocks or equity indices, or similar as for an FX pair. More importantly, what it does is it makes a new high. Okay, and then it closes below the previous day's low. So there's a complete turnaround in that session. In a downtrend, price open either below or the same as the previous day's close, makes a new low, but then closes higher than the previous day's high. All right, try and reinforce this every week. It is about, you've had effectively, total overwhelm, all right? Total psychological overwhelm within the market in that particular session. In an uptrend, the bears have stepped in and wrestled control, okay, and they're now in control. In a downtrend, when you see a key reversal, well, then that's a sign that bulls have stepped in and wrestled control of the market. Okay, so that's what I'm looking to keep an eye on. And even though you'll hear traders call it a KDR, key day reversal, whilst lots of them like to trade them on the daily chart, you will find them on all time frames across all instruments. So a version of that was also the momentum reversal candle, and very often key day reversals are lovely setups to trade, but they don't happen anywhere near as often as we'd like. And so a version of that is what we'd call an MRC, a momentum reversal candle. Some people might call these swing points, some people might call them swing candles. That's okay. It's what particular name you give to something doesn't really bother me too much. It's about understanding the price action, okay, understanding the actual concept behind a momentum reversal candle. So for, let's say, for a buy, we talked about price in a downtrend, price makes a new low, but it closes higher than the previous day's close. Okay, a key reversal closes higher than the previous day's high. But momentum reversal just has to close higher than the previous day's close, all right? And also the low should be lower than the previous 3 to 5 bar closes. So it's it's not as powerful as the key reversal, but it happens a good deal more. So it's about being able to sort of trade what you see in front of you. So then last week, what we talked about was a little bit of a combination pattern of using the 1, 2, 3 pattern and the key reversal pattern. What we talked about is, after a good trend, part one, I take an interest in a market when a price prints an individual reversal candle on the daily or maybe the weekly chart for longer term traders. Could be a key day reversal, but it could also might be an engulfing pattern or a pin or rejection bar. Okay, sometimes they can be, a key reversal can also be an engulfing pattern and a pin rejection bar as well. Okay, so it's about looking at what happens, and then after that happens, I wait for a 1, 2, 3 pattern to form. Okay, that provides me with a lower high if I'm looking to short a market, and the whole idea about this particular setup is that I'm not trying to pick the exact top. Okay, I'm not trying to pick the exact top. I'm just trying to pick a good point to take a possible, in this case, short position that provides me with a nice tight entry, but also very quick feedback if I'm wrong in my trade selection. So for a 1, 2, 3 pattern, okay, it's very, very, very simple. All right, okay. What we'll see is we'll have price makes a high at 0.1, price falls away, it makes 0.2, price rallies up, and 0.3 shouldn't be any higher than 0.1. If you use Fibonacci, if you use particular theories, then you could go into that in a good deal more depth. But for the purposes of our starting here, I'm just looking for it's a pattern to be a 1, 2, 3, and I start to get interested at 0.3, especially if 0.3 also happens to be a let's say a useful price action signal. Okay, the 1, 2, 3 pattern is that it's I feel it's like the market is giving the traders the last chance to get on the party bus before it moves. And as I said, if I see it as a nice combination, okay, in terms of 0.3 is also something like a pinbar, an engulfing, or a spinning top, maybe a key reversal. All right, well then that gives me more confidence. So remember what I was saying, right? A good few slides back. It's about waiting for a bit of a confluence of events to occur. Okay, and that's what I was looking at there. Okay. And another thing we talked about is that part 4 is optional. Is that one of the reasons I like the 20 period moving average is that there are a lot of buy and sell programs that run just simply off that, and so if price is being capped by the 20 period moving average, if it's acting as a bit of a roof, that just gives me more confidence that maybe that particular market's ready to roll over, and and there'll be a trade opportunity for me. For myself, I'm just looking to sort of trade the break of 0.3. Okay, if you're looking for a target, well then you should be using at least a 2 to 1 target, or if you prefer to use a trailing stop, which is we're going to do that in a future session. Well then you're looking to use something like maybe a 2-bar trailing stop and see whether the opportunity arises for a good long trade to run for you. So yeah, if you remember, we talked about a few examples from last week. Okay, this one was on the dollar index at the start of last year. There was an uptrend in the dollar. Then on the monthly chart, we got a big key reversal bar, which then on the weekly chart actually sort of flowed through into a nice 1, 2, 3 pattern. Okay, we had lots of rejection candles at 0.3. The 20 period moving average was acting. It turned from support to resistance. And then what it showed us was the sort of the trend of the dollar for the next sort of 7-8 months. All right, so when these things happen on the bigger charts, they don't happen anywhere near as often as we'd like, but when they do, well then it does provide us with an opportunity to sort of to get on board into a trade. So there you go, ladies. I always try and fly through those. Okay, it's just more a case of the more times you. I appreciate some of you are joining us for the first time, and some of us are just looking to effectively. Let me just go back. Just it's a case of once you hear it, it's like repeating constantly for you. So the more times you hear it from me, the more time it sinks into our skull. If you're anything like me, sometimes I need to hear things a few times for it to sink in, for it to become part of how I operate. So part of it is about it's a little bit repetitive in terms of just you hear it. It's like osmosis. It just sinks into your brain. Okay, and this just becomes the way you operate. Okay, and that's what we're trying to do. And trust me, there is method in my madness, ladies and gentlemen. Okay, and as we get onto the sort of managing myself parts of the Admiral Markets Mastering the 4Ms webinar series, that will become more evident as to how and why I'm operating like that. So let's go on to step 5 then. All right. So with step 4, we were talking about looking for particular price action signals that at the particular areas and zones that we're interested in, and now we'll have a little look at some general chart patterns. All right. Some of you might have experienced it. Some of you might actually know them very, very well. Others might have be aware of them, but not truly understand them. And so hopefully this session and maybe the next week's session will where we'll do on it, and we'll give you just a little bit of help and a little bit of insight. And for those of you who are experienced, maybe it'll just be a little bit of sort of sort of an overview, a recap for you. So, general chart patterns, okay, what I'm looking for here is that, what we actually start to see is things like lines of support resistance that actually, that start to create various chart patterns that are actually very tradable themselves within markets. So when we talk about general chart patterns, we basically have 2 types of patterns, all right, a continuation pattern and a reversal pattern. So pretty simplistic to understand. A continuation pattern, all right, we are expecting the trend that we came into the pattern to continue, and a reversal pattern, we're expecting the trend that we came into that pattern to actually reverse. Pretty simple to understand. Today we're just going to focus on continuations. Next week's session we'll do a bit on reversals, but we're just going to focus mostly on continuations for our session today. So, some of you who are, let's just say if you're new to trading, you may have heard these expressions, but actually have no idea what they are. So, continuation patterns, okay, what we normally tend to hear are patterns like bull and bear flags, ascending and descending triangles, and also symmetrical triangles. Reversal patterns are things like head and shoulders, double top and bottoms, triple top and bottoms, coupled handle, and things like an island top and bottoms, which, to be fair, are more prevalent in stock trades than in things like FX and commodities and indices. But we're going to focus, as I said, on continuation patterns today. If you join me on the Tuesday morning real-time daily trading ideas slot, okay, I'll very often talk about some of these patterns as an indicator for myself, and I'll talk about more about that as we go through. So let's have a look at the first one, flagged pattern. Well, it's the good thing about these general chart patterns is the names are pretty reflective of what it looks like in a chart. This is what we call like a bull flag. Okay, so we have, here we go. Let's use the old drawing tools that we've got here as always. So what we have here is we have a flagpole here, okay. Then what we have is you can see there's a kind of a nice flag pattern there, okay, nice flag pattern there. And what we're expecting, it's a continuation pattern, so we're expecting this is the trend we came in on, so this is what we're expecting it to come out on, okay. We're expecting that trend to continue. Pretty simple, hey? And what we'll also be looking to do is you'll start to hear as classical technical analysts would effectively they'd be measuring the flagpole and looking at that for as a target, and we'll touch upon that a little bit more in a moment or two. And a bear flag is, well, as the name implies, all right, it's the exact opposite of a bull flag. Okay, we've been in a downtrend, price comes down, price rallies up again. Okay, creates a nice little flag before, all right, the trend continues. Okay, very, very simple, right? Very, very simple. You know, as I said, these patterns, you will see them across all time frames. Okay, all time frames and all instruments, and they, you know, I know a couple of clients of my own who, you know, very happily just sit and trade, you know, flag patterns on shorter time frames. You know, they can see it, they can understand it, they know where, you know, they can make very simple trade plans around it. Okay, and so, you know, these patterns are very tradable. Okay, and it's about just being able to sort of see them and work them and understand how to trade them well. So here's a little bit of an example. This is you know, it's a bit of a 5-minute chart on the dollar yen. Okay, which is might be a little bit more aggressive than people sometimes are used to. But what we can see here, you know, we actually see there's a support and resistance pattern in a downtrend. Okay, it's just a small, tight little flag pattern. Okay, as always, we want to identify, you know, where is the flagpole? Okay, where is the flagpole that we came into? All right, that's our flagpole, which is what we use for our target. We can effectively project that from the breakout, and that will give us our target. Okay, so it just becomes a very simple. It's almost like a simple sandbox trade in the sense that you know where you're getting in, you know where you're getting out, where you're wrong, and you know where your target is. So you know you can almost kind of, you know, set and forget as a particular trade. Here's a flag pattern on this will be Whitbread. It's like a UK, you know, it's a major UK FTSE company. Some of you might be aware, you know, Whitbread had just recently sold Costa coffee to Coca-Cola. Okay, but you know, what we saw here is, you know, the price was in an uptrend. It provided a sort of a flag pattern there before price continued to move on. And then actually even on the daily chart, okay, we could see that as price was moving up in a trend, it was actually just moving up and then actually coming back, forming a nice flag pattern before it made its next move north. Another pattern, sort of, I said there on Facebook. Okay, we can see, you know, there's a long uptrend. Okay, price sort of forms that flag pattern before it projects and carries on. And a little sort of a kind of a little let's call it, like, I don't know, maybe a little trader's edge element here is that personally, for flag patterns, what I like to see is the flag pattern end with, you know, that candle there, which is a pin bar. It's a rejection candle. If you remember, we touched on that, well, just a few slides back, and we did a proper session on that a good few back, and you'll find that in the sort of YouTube channel. But, you know, very often I will like to see, you know, a kind of a flag pattern finish with a rejection candle. Okay, and we can see that it was bouncing off that 20-period moving average before price actually took off. All right, and that's what we were particularly looking for. And then that kind of move was stopped with a momentum reversal candle there. Price, you know, pushed to new highs. Okay, and it closed lower than the previous day's close. Okay, so hopefully you can see that gives you a little bit of insight into that. Let's remove those drawings. So, you know, that was flag patterns. They're very, very popular and very, you know, very popular with traders. But what we also have is ascending and descending triangles. Okay, an ascending triangle is, you know, what we're expecting is, let's get the pen out, is that, you know, we've got a level here. Okay, you know, pretty, you know, solid resistance level. But what we're having is being able to draw under this. Okay, is a case of, you know, we're getting you know, higher lows all the time. Think of it like it's like a squeeze. Okay, it's like, you know, we're getting squeezed, you know, from the top, and we're getting squeezed from beneath. All right, and what we're expecting is that actually for price to, you know, to continuation. It's a continuation pattern. That's what we are. That's what we're looking for, and that's what we're expecting. And the opposite is, you know, a descending triangle, right? And, you know, it's just the same idea in reverse. We'll have a strong level of support, and what we see is, you know, we see each of the highs being lower and lower. And as I said, it's like a squeeze going on. Okay, price is getting squeezed. Okay, and at some point it's gonna explode. All right, and we want to be ready to be able to sort of take advantage of that. So here's another example. This is another sort of short term on pound against the yen. We can see that we've got a resistance level where we're getting, the highs are getting consistently lower and lower, but we have a pretty solid support line underneath, and then we can see the price actually sort of, what we do is, from the sort of the last trough, we're able to sort of take a reading from to the high of the resistance level. That gives us a base price target, which we can project forward, and that gives us a target for our trade. So once again, some people like trading these patterns because it's a bit of a sandbox trade. Then they know where they're getting in, they know where they're getting out if they're wrong, and they know where their target is, and so it becomes a bit of a set and forget trade. And for some traders, that's actually the best way for them to operate. This is, kind of an ascending triangle here. Okay, we can see that there's a resistance level there. Okay, we can see that we have a support level here. Okay, a support level that is is working very nice. Okay, it's giving us, we're getting, there we go, we're getting higher lows constantly until price breaks out. We can see price breaks out, and then actually, for those of you who are sharp and eagle-eyed, you'll see that actually price, then gives us a flag pattern, doesn't it? Flag pattern there. We have our flagpole. We have it ending there with a pin bar before it actually breaks out and continues on again. So there's a kind of a nice little sort of a double sort of pattern there. Okay, and that's what can happen. This is your $1.30 minute chart, but as I say, this could be gold on the weekly, or it could be Bitcoin on the 4-hour chart. Okay, these patterns and these these things they set up again and again and again. So there we are. There's the base price target. Once again, we just project it forward. That gives us our target, which is actually also where the flag pattern sort of got ready to fire off as well. So nice nice double setup. And finally, then we've got kind of like symmetrical triangles here. Okay, so here we are, and as the name implies, that's what we're expecting to see. It's a symmetrical triangle. I quite often talk about these on the real-time daily trading slots, or Tuesday at 10. And what I'm talking about there is, I'd like to see this is when the market is starting to coil up and getting ready to move. Okay, price is coiling up. Okay, price might be having a rest. Okay, after a big move, and I'll show you a chart in a moment or two that will sort of imply that. But what I look at it as it's like the price is coiling up. Okay, it's like a coil. It's being tightened and tightened and tightened like a spring, and then we're expecting it to explode out of it, and that's what we're looking for to be able to trade with. So here's just another little example here. Okay, we've got euro yen here, resistance level to the top, support level to the bottom. Okay, but you can see that what we're looking to do is to identify the sort of a base price target there. Okay, from the kind of the sort of the last trough to the other side of the triangle. And then that gives us a sort of a projection level, okay, upon which we can utilize to give ourselves a target. So you can see that will work, and in let's say we'll come back and look at these charts in a few months' time when I give you a little bit more of the, let's call it like the advanced sort of levels of it. But for the moment, I understand we'll have some people who are either A, just new to trading, or B, just trying to build their confidence in being able to identify patterns, and as I say, these patterns, they occur time and time and time again across all of the charts. It's just another little example here. Okay, so this we'll see this is a very kind of as a shallow triangle, but it's you've got to think about the psychology behind it. What is actually going on? What is actually happening? Right? What we're seeing is price is coiling up. It's getting we've had a here we go. Let's draw it on here whilst I can. We've had a bit of a surge. Okay, we've had a good strong drop, and now price is just working out what it's going to do. What's going to do? It's taking a breather, and then bosh, it's off again. Okay, and that's the way to look at it. Markets are even with the computers working away. Markets are still made up of humans, and humans in everything we do. We surge, we rest, and we surge. That's what we do, and so we want to just have that in mind in our own sort of understanding of trading markets. So yeah, once again, as always, we're looking to take the identify the sort of base price for the sort of the first peak or the first trough, and then looking to use that to project that from the breakout to give us our particular first target. So there you go, ladies and gentlemen. There's, we've covered a few of them there. What I tell people is, I put that, I put that particular chart up there, okay. But what you can do is, take a screenshot of that. If you haven't got one, just stick it up on your trading wall, all right. And we didn't really look at Pennants in the same way, but they are there, and we will see them. Okay, that they're just a version of a symmetrical triangle, and they are, as I said, there's ascending triangles, descending triangles. Okay, and then we're looking at pennants, looking at flags, symmetrical triangles as well. Okay, and that's what we particularly wanted to look at and focus on, and hopefully you get you'll be able to sort of as I said, print that off, stick it on your wall, just practice. Okay, there's no secret sauce in that sense. It's just a case of just open some charts, go through them, start to draw these patterns in, and you start to get a bit of an idea. You start to build a picture of what's going on within those particular markets. Also, there's reversal patterns. We're not going to touch them today, okay? But this is what we'll be covering in the next session, okay? Just a little bit of an idea, get a little bit of an insight, okay? Just into some of them. I use a mixture of them in my own trading, and you'll see them as we touch upon them as we go through. So just before we look at the charts for the last couple of minutes, all right, I'll talk about starting to build a little bit of a little bit of a profile for sort of the mastering the 4Ms. Okay, I'm going to focus on the dollar index, which is crucially important, and then 28 other major pairs, which is just really the kind of the crosses between the sort of major pairs, okay, the major FX pairs. That's enough. I know some people like to trade the really exotic ones, like the Polish zloty against the Singapore dollar and stuff. That's fair enough. Whatever floats your boat. The reality is, though, that to begin with, I tell people to normally just focus on trading the major pairs. The major pairs mainly because the big, the liquid, they can be traded easily. Okay, and normally they have tight spreads. So in terms of cost of business, then you have to consider that's much easier for you to absorb as a trader, and that's something we'll talk about in a few months time ahead, when we're looking at the kind of that's kind of like sort of the advanced elements of understanding and building a trading business. Also, just want to keep an eye on the indices, all right, the major indices. So we've got the S&P 500, the Dow, the Nasdaq, the FTSE, the DAX, the Nikkei. You can have a look at some of the hard commodities, oil, gold, and silver. If you like the agris as well, you could add them in. Equities, well, people talk about the FANGs, all right. Of course, they've had a little bit of a challenging few months, shall we say, over the summer, all right. So that just gives us opportunities, and also now with Admiral, you also get the opportunity to sort of trade the crypto. So like Bitcoin, okay, Ethereum, Litecoin, and Ripple, etc. So we're going to be using that as we build our plan, as we sort of transition from, let's say, the kind of educational element of the mastering the 4Ms towards actually, how we actively sort of look to operate and trade as in our business. But that's what we're going to be focusing on, and that gives us plenty of opportunity. And I know that some people will focus on one or two, maybe particular asset classes, or one or two you might focus on particular instruments. And that's absolutely fine. Absolutely fine. If you have a couple of particular instruments that you really enjoy trading, and you really feel that you have a good handle on them, then that's absolutely fine. That's absolutely fine. But I also appreciate that for those traders, sometimes actually building in a little bit of a let's call it like a big picture view of what's going on across the big major markets. That in itself can be very helpful in terms of building our situational awareness about what's going on in the overall market spheres. So as always, ladies and gentlemen, I talk about we want to be having a little conversation with yourselves about understanding those 4Ms of trading. All right, remember to manage them yourself. Markets, method, money, and myself. At the end of each week, just have a quick word with yourself. Have you managed to manage those 4Ms well this week? Okay, have you learned anything new in those 4Ms? Is there anything that you've maybe slipped on and that you need to just ensure that you're covering? Okay, remember what I say is the traders who I see who do really well tend to have all of those 4Ms in alignment, and that's it's a key element. Okay, so if you're having a challenge in your own trading, well, think about which one of those 4Ms are you having a bit of a struggle in, because that will probably help you start to look at creating a solution. So as always, ladies and gentlemen, if you've got questions about the session or about Admiral Markets or about the products and services, by all means, give your account representative a call. They'll be happy to have a chat with you. You can call them on that London number, 02077264003. Drop them an email at hello@admiralmarkets.com. You can watch this recording and all the previous ones on their YouTube channel, youtube.com/Admiral Markets, or join them on their Facebook page, okay, facebook.com/Admiral Markets Global. So I hope you found that useful and interesting. As always, just for the last minute or two, I'll have a quick look at some charts. If you just bear with us, I'll just switch across. Okay, so bear with me if you will, ladies and gentlemen. Just hopefully, just here we go. Let's do that. Bring this up. Okay, so here we go. Hopefully you can still all hear my voice. Hopefully it should perhaps be filtering in for you to sort of see the screens. Okay, sometimes it just takes a moment or two to update. So there we go. I'm hoping you can all see it. Well, for the last couple of minutes, just not surprisingly, okay, those of you who've heard me talk on the real-time daily trading ideas session, well, that's it's a case of on the daily chart. That's I see that at the moment as a very, very big descending triangle. Okay, so I'm waiting to see, will that pop out? Hopefully you can see that yourselves. Okay, it's just that's been building all year. Effectively, that's been building all year, and I'm going to be interested to see will it be a continuation pattern and break down beneath 6,000 and continue on, in which case that starts to get us into very interesting territory. Okay, or could there be a bit of a squeeze and we get the next sort of crypto bull run? That'll be I'll be interested to see if that was to I'd be interested to see if that was to occur. Let's just have a quick look at the Dow here, okay? So the reason I'm looking at the Dow is what we had here. Let's see if I've got this on the 4-hour chart, okay? So, what we had was, if I just let me go into the daily chart, we had here, price pushed up to new highs, okay, then put in, there's a rejection candle there, okay, we had a bit of a false breakout, price rolled away, okay, and fell away, and we had, we talked about the 20 period moving average. It was acting as dynamic support, but that big sell-off just effectively, just collapsed it down, and price fell back down to the 200 period moving average. And you can see, price has reacted there in the past, okay, you might be able to see there, okay, that was effectively, a 3-bar reversal there that, we were in an uptrend at that time. Okay, the 200 period moving average is nicely pushing up. We had, 2 red bars followed by a green bar, which was also a rejection candle, and price sort of just has continued there. But when I look at, what happened after, the sort of the big fall that we had just last week, okay, well, actually, after we had the big fall, price went into that kind of symmetrical triangle, didn't it? Okay, but here's the interesting thing. You would normally have expected, okay, the price to sort of collapse and fall out, but actually what we had was a little bit of a pop to the north side there. Okay, we had a little bit of a pop. So as I said, we expect it to be a continuation pattern. The bias would be towards continuation, but you have to trade what you see. Okay, you have to trade what you see, and interestingly, we did have that pop up there, but actually price is sort of rolling back here, and actually we can see prices respecting that 50 period moving average there, isn't it? It's acting as quite nice dynamic resistance there, so we're going to be interested. I think it's going to be an interesting week to see whether actually whether that would be a false breakout, and then actually we are going to continue down. But if we probably were to look at some of the other American indexes, you'd probably see that they did pretty much the same. Okay, there's the S&P 500. It fell. All right, it fell. It's put in the sort of triangle. Remember, as I said, it's about thinking about prices coiling up, getting ready to blow. It takes off. Okay, then actually it falls down again. Okay, and we can see it respecting that 50 period moving average, can't we? It's kind of on the 4-hourly chart that that's in control at the moment. We're just looking at China. Okay, China is, we had some interesting information. They sort of effectively they had their little bit of they had their sort of Draghi moment there. Okay, sort of over the weekend where the sort of premier of China, came in and said he'll do whatever it takes to support the private markets and brokerages, and that's what we've seen there. Okay, that's what we've seen there, and I'll be talking about that a bit more tomorrow on the real time daily trading ideas session. Okay, but But we can clearly, what I'd be looking at, as always, I'll be looking at here that, we've had there around about, could be sort of 11,000, all right, 11,000 down to about 10,800. Okay, I'd be saying that, we had support there, and actually what we had was, we had a bit of an engulfing candle there, didn't we? A bit of a key reversal candle there, okay, from sort of Friday. Price pushed to new lows and then basically closed above the high, and then of course on the Sunday your man comes out and says something, and so when the markets opened last night they had a nice big bounce, and that's the way we see it. Super, ladies and gentlemen. Okay, well, we'll call it clips there. I appreciate I ran over a couple of minutes. Apologize, just trying to get in as much as I can to share with you. I hope you found that useful. All right, if you're watching this on demand, please, enjoy it and take your pleasures from it. As always, just go out and practice these things. Just look at charts and work at it day after day. I look forward to seeing you either on the Tuesday real-time daily trading ideas at London at 10 o'clock, or I'll see you next Monday at 4 o'clock London time for the next episode of Mastering the 4Ms of Trading. I wish you the very best of success in your own trading, and I look forward to speaking to you soon, ladies and gentlemen. Many thanks. Thanks, Phil. I appreciate the feedback. He says, thanks, Paul. Great pointers. That's super. Thank you very much. All right. And I'll see you guys and girls next week. Good luck.